Gold doesn't do so well in a rising interest rate environment because gold does not pay interest. Gold doesn't have to pay interest. It's the single safest thing that you can do. And that's not just according to me. The Bank for International Settlements, it is the only financial asset, not one of two or one of five, the only financial asset that actually runs no counterparty risk.
With its long history as a store of value, investors have traditionally used gold and silver to hedge against stock volatility, currency fluctuations, and other market risks. But with gold and silver prices tending over the past year, as other asset classes, including cryptocurrencies, have rallied strongly, many investors are wondering if gold still deserves a place in their portfolios. Gold's recent underperformance has been influenced by several factors, including central bank activities, potential changes in interest rates, and runaway inflation, all of which are undermining confidence in this long-term safe haven asset. Given that the price of gold has lagged in recent months, is this now a buying opportunity for gold, or should investors wait to buy the precious metal? In today's video, we'll tell you why Lynette Zang says that this is the best opportunity to take advantage of silver and gold. But before we get into the video, make sure you subscribe to our channel and press that bell icon to never miss an update. Investors generally tend to favor inflation protection assets during an economic period when the prices of goods and services are rising, such as today, because it is the end of the currency's life cycle. The stock market is going up, and the truth is that there's no more value inside the currency. As long as inflation is higher than the applied interest rate, it is a lose policy. If companies can borrow money at zero, what we have seen for many years is inflation. It shows you that the value of that money is nothing. If interest rates are below the level of inflation, that means policy remains loose. Monetary policy is flexible, and this is a great advantage for those who have the capacity to borrow. The markets depend on this abundant and cheap money and have a lot of debt that needs to be rolled over in a higher interest rate environment. And because the banks didn't want to show these losses on the books, they continued to lend money in order to meet their minimum payment requirements. In the context of rising interest rates, this is no longer working so well. So they expect the Fed to curb those rate hikes or stop or reverse them, ideally for the markets, but they will reverse. Gold doesn't do as well in a rising interest rate environment because gold doesn't earn interest. Gold does not have to pay interest. It's the safest thing you can do. You have to have physical gold, physical silver in your possession to weather this storm because it's going to get much more bumpy, much more stormy. Proponents of gold have always viewed it as a safe asset that protects purchasing power against inflation in times of economic hardship, as it tends to retain its long-term value despite fluctuations. While there's a correlation between gold and inflation, this relationship could break down in the near term due to multiple factors such as bond yields, US dollar volatility, and other risks that have a more significant impact on gold than on inflation. But gold is likely to regain its status as an inflation hedge as the current inflationary period continues. Inflation and inflation expectations may support gold prices even if 10-year Treasury yields rise. Inflation turned out to be less transient than expected and likely difficult to tame with lingering issues like supply chain issues, rising energy prices, potential stock market volatility could bring gold back into the spotlight with its proven role as a portfolio diversifier and hedge. An important factor that will affect the future of gold prices is the course the Federal Reserve takes in monetary policy. The Fed is expected to start raising interest rates in 2022, a less positive scenario for gold. This is because when interest rates rise, the relative cost of investing in gold increases, as it is an asset that does not pay dividends or interest. In a rising rate environment, gold may not be an attractive asset for investors to hold in their portfolios, which could affect investors' future gold holdings and put downward pressure on the price.
Give me gold. I don't give a crap about these little bitty itty bits of interest. That's nothing for the risk. You're going to risk your principal for a teeny bit of interest. And if you lose all your principal, what do you have to work with to rebuild on the other side of this? Nothing. Absolutely nothing. That's why it is imperative that you have physical gold, physical silver in your possession to ride this storm out, because it's going to get a whole lot bumpier, a whole lot stormier, and I really want you to be protected. And I want you to have the ability to take advantage of the opportunities that are going to present as these bubbles pop and the whole The whole Ponzi scheme.
That's all for today. Let us know your views in the comments section below. And don't forget to like this video before leaving. Thanks for watching.